Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, all. We will let folks kind of come join in, and then we'll kick things off for the first weekly notebook review of 2023. All right. So thanks everyone for joining again on a great Wednesday afternoon. I think this is really going to most likely be the time slot that we'll be moving forward with, kind of given schedules and stuff like that. But going back kind of old school spaces, aftermarket close, so 4:30 throughout 2023. That's the at least the initial game plan here on January 4th. So January 4th, 2023. Hope everyone had an absolutely brilliant holiday season. Both and the new year is off to a fantastic start. I know, as I alluded to in my tweet, and certainly the title of this space, pretty much the similar signals across the board to start 2023. So, it's all about kind of executing in the moment. Keith sent out a lot of RTAs this afternoon going into the close with a very similar kind of thought process or theme, which was really about execution, not thinking. Top Gun Maverick was really the key focus there in terms of who you should be channeling, and then where you should be channeling. That focus and energy was certainly on a lot of high beta and high short interest type exposure. So I think that was pretty interesting. Well, maybe interesting is I should use a better word choice. It was a telling, in terms of where Coach went to go hunt. There's a lot of signals here that certainly we've been, have been core shorts for us on the short side around, tech and consumer discretionary, et cetera, et cetera. But they really have been kind of lingering and even today. So, much more kind of closer to the middle to bottom end of the risk range, tech and both the Qs and XLK, try to make a bit of a bit of a run higher here at the end of the day. But really, the stuff like retail and even Jets kind of stood out to me. Jets was something that we were on earlier in the year that had a big day in terms of a counter trend bounce. Where did it finish today? So it was up, 5.25% today. So again, I don't know the short interest off the top of my head for a lot of those underlying holdings there, or even for Jets itself. But I suspect with that move that there's probably a decent amount of short interest there, and you're seeing, that up 5.25% on relatively low volume in terms of kind of on an average basis. So that volume today, my numbers I'm seeing about, what is that, 500? Yeah, normally about 500 million shares or 5 million shares. And sorry, it's hard to read this right now. An average is normally closer to 6, so over 6. So again, that was an interesting one that certainly popped out of the page to me in terms of U.S. sector exposure, right? So a lot of things today. GDX is something that we've obviously had in the book for the last month plus, and that's been a great exposure. Doing the weekend work year to date, obviously up 7.89%, but over 5% in last month and 25% in the last 3 months. So that's been a great exposure to have. There aren't many on a 1 month basis that are green on the board, other than sort of utilities, GDX, and interestingly enough, home builders, so ITB. So again, that's just something that I want to call out here in terms of signals. I didn't get a chance to talk to Keith in terms of what his signal is on ITB, but I know on the REIT side, it's still, bearish trend, because we get that in the out bucket within the risk range product every day. But for whatever reason, the home builders are sort of have positive momentum, at least from a price standpoint, on both 1 month and 3 month basis, and have started the year off up 3.62%. So just a little bit, a little something there to call out. I think if you look at the underlying hood of home builders, a good there is some exposure to some of the things that Brown McGough doesn't like in terms of like Home Depot and Lowe's and stuff like that. From that perspective. So again, a lot of these ETFs, you got to go under the hood and take a look at what the exposure is. Some of the other exposure there is to, things like Pulte and Pulte Group and stuff like that. And so some of the actual home builders themselves certainly look a little bit better from a single standpoint, or at least on my screen, and they have a larger weighting as well. So again, it's really important to understand, what's under the hood there on those ETFs and that kind of thing. But the big call outs to me, again, going back, it's one of these things where a week off, you kind of come back in, and I was paying attention, but really kind of in terms of writing things down and the risk range and sit down in the morning and that kind of stuff, it really kind of picked that back up obviously yesterday. Well, did weekend work, what have you, but yesterday, and then so you get kind of a bit of a fresh slate, right? Because you really were looking kind of, I was reviewing day over day, but really get a chance to review kind of where things stood week over week. And interestingly enough, it wasn't, although it wasn't a huge kind of, not a lot change from kind of signals, again, from signal standpoint, hence the title of today's episode or of the weekly notebook review. But the big thing here in terms of there were definitely some lower highs that I think are important to point out. One is obviously just in the S&P. So lower highs on the S&P. Keith's been preaching that across the board, certainly reiterating that in a lot of RTAs. But you're also seeing it on some of the things that we are long, right? So things that are on the bullish side. So consumer staples, healthcare, Utes. You're seeing some lower highs there. Now in Utes, you're also getting some higher lows, and same with staples, right? So some of these signals are a bit more of a consolidation standpoint versus necessarily weakening. But it's always really important to understand and to look at where are those risk ranges and what are they doing kind of day over day as well as week over week. And like the top end of the risk range for XLP, for instance, is no longer would no longer be putting in a 1 month high in its current stance right now on a trending basis, or kind of from the ETF Pro product that we get. That's certainly much closer to the top end of the risk range. There is much closer to the current 1 month high in terms of from that price standpoint. That number is around what is that? That's around 76.70, 76.79 to be specific. So again, these are just things to be noticing, paying attention. A lot of the the weekly notebook review here on Wednesdays is trying to get a sense for what was what we saw over the weekend coming into the week versus what actually is transpiring on the page and on paper. So again, just wanted to call out staples there. Things like healthcare certainly look better, and same with and utilities as well. Although I think they had a pretty good day today. So they were definitely green on the screen. So something that was working for us, especially if you acted earlier in the day when they were up almost at the top end of the range there. I think the high today was around was at 71.78. So I won't give you the top end of the risk range there, but that certainly would have been a great spot to be selling some of that exposure and that kind of thing. So again, it's kind of just executing and looking at what these signals are looking at. So I wanted to call that on the U.S. Equity side of things. On the short side, what does keep falling out of bed is really tech, and I kind of alluded to that a few minutes ago. But the lower lows and lower highs on tech, whether it be the Nasdaq and or XLK itself, that thing just can't seem to get out of its own way from a risk range standpoint. So interesting here. Now again, a little bit difference in terms of looking at the 1 month versus the 3 month. So keep that in mind. Keep track of where that 3 month low is from that perspective, as well as where the 3 month high is, right? So I know, Other Side Asset Management commented yesterday about the VIX risk range and the lower highs that it was putting in. But what you always got to look at both sides of the coin, right? And the fact that um, yesterday, VIX had a lower high and a higher low, but today there was a new higher high was actually put in terms of the top end of the risk range. So things change day over day, but in terms of XOK, keep an eye on where that low end of the risk range is, and in comparison to both, our trade and trend durations, definitely really important to keep on top of that as we move into 2023 and kind of get to reassess, not only what's in our portfolio, but where we put our capital to work, right? So I want to call that tech out. I think the other thing as well, which is if it's not glaringly obvious to you, definitely go back and do a little bit of work, because what's happening in the energy space and the breakdown in kind of commodities, but specifically crude and natty gas in particular, is just quite quite mind blowing, to be honest. At one point that risk range, I think a week or two ago, was neutral on natty gas, and it basically has just been putting in new lows very consistently for the last 15 days, really. So definitely keep an eye on there. And then conversely, in precious metals, you're seeing a lot of very positive, a lot of really positive price momentum, and certainly positive signal strength on both gold and silver. So I think those are both pushing the top end of the risk ranges today. So I think everybody on this call should understand what that means, and what you should have been doing, and that would be sell some, right? So this is why you kind of you touch your portfolio in a very dynamic manner, right? You're pruning and planting here, and you're kind of executing at the fringes of the risk ranges. So just I wanted to reiterate those from standout in terms of commodity space, and then lastly, in terms of certainly, the bond market, right? It was a thing that was highlighted this morning on the macro show. But these signals, from our discussions here on this call, even just 2 weeks ago, maybe 3 at this point, but certainly, they were moving from bearish trend on the 10 and 30 year, kind of flirting with neutral, and now squarely back in bullish territory. So again, these things ebb and flow. I think if you've been these risk ranges have been spot on, in my humble opinion, in terms of what we've been seeing there. And if you're kind of, again, executing on the fringes and/or paying attention to where those top end of the risk ranges and low end of the risk ranges are, you can really generate some alpha and make sure that you're not positioned in places where money is flowing out of versus flowing into. Trend, welcome, my friend. I know you said you were going to be a few minutes late, but appreciate you jumping on to another weekly notebook review. Thank you very much. And so, I kind of, I've gone through a number of things that I'm seeing, in the FX space. Euro certainly started to break down this week. So again, I think these, the euro, sorry, I'm just pulling it up now, your US dollar. Again, these are things where, this is one of those things depending on what your time horizon is, right? So I think a lot of folks, they have different time horizons. So, we've talked about this a lot in the last month, I'd say, and certainly on both here and a beginner's guide, but understanding your process, understanding your investment horizon and where you want to live, right? So there's money to be made really across multiple durations. And so if you want to be more intermediate term or kind of, day trader, it's not really where I live. Sometimes I will, if I see an opportunity, I will go in and kind of take it. But for the most part, I do try to capture more of the full investing cycle. And, the Euro US dollar to me is setting up as one where, it remains bearish, trend, and the recent price action here, if it continues to sort of put in lower highs, then that's going to be really favorable in terms of basically this 3-month counter trend move, and sort of it recapturing that downside momentum. So keep a close eye there. I know Keith is reiterating that fact and has done so last few days, but definitely the Euro US dollar pair is one that I'm watching closely. The Canadian dollar continues to be, I called that out last few weeks, but there's a big move, big bounce today, up almost 1.41%, right to the top end of the risk range. So again, hopefully you were executing there as you needed to, but this was definitely one yesterday. The divvy hit, I think, on FXC. Not I think, I know the dividend hit on FXC. So you could have easily been sort of pruning some, aka covering some yesterday on that move down. Now again, anyway, it doesn't matter, and then you can basically be putting it back on today at the as it moves closer to the top end of the risk range. So again, keep an eye there across the board. Canadian dollar is a great way of expressing not only weakness in the Canadian economy from a quad perspective, but then also in terms of energy exposure as well. And as I said, that continues to break down. Lower lows and lower highs. Today's oil top end of the risk range on crude itself was such a massive lower high. I mean, it was just shocking, in fact. So that's kind of FX, running through FX, fixed income. The international space, right? If we kind of go across the board there, again, we saw the Nikkei just absolutely go, just turntailed in regards to going from bullish trend back to post the BOJ announcement. Was that about 2 weeks ago now? And just absolutely, it's been demolished. Equity market has not appreciated what is transpiring in the Japanese bond market, and therefore, that is squarely back into the into the bearish trend. I did not short that, but would have been a great one to do so post that BOJ meeting. DAX again, Europe kind of setting up here. I think that's been, Coach kind of mentioned that again this morning, but totally agree with him there in terms of the European setup. I think this has been a counter and rally, but the real issues that are on the horizon are going to start to sprout back up, and reality is going to take hold. To me, one of the best setups right now is obviously, remains sort of some of our, if you just go to ETF Pro product, I'm not going to kind of hand out there for everybody, but just go in there and look at what European exposure we have. And then obviously we've been adding a decent chunk of energy exposure on the short side as well. So keep track of that. And Bob's your uncle should be generating some alpha. So trend, I will
Hey,
pass the puck to you. How you doing?
hey, how's everybody? I hope everybody had a good New Year break. And now
Yeah.
that we are regrouping, this week is kind of short because Monday was a day off. I hope everybody enjoyed
Mm-hmm.
with their families. So, first and foremost, uh, today's event at 11 a.m. with Mike Taylor, I hope everybody got to see it. And everybody enjoyed it. A couple of takeaways from that were his current book is neutral. And again, that's not a signal, that's his process, right? But from our standpoint, from my standpoint, I actually went neutral in last week of December, just before we had that fierce last 2 days of rally. And then I've been slowly, steadily adding 50 basis points here, 50 basis points there on several names. So as of right now, I'm still close to neutral. And from a portfolio perspective, from a notebook perspective, a few things that started jumping off for me were definitely ITA and the defense stocks. They're actually making pretty strong advance here. The second set I wanted to bring to everybody's notice from a notebook perspective is commodities. Now, specifically energy. So I track a couple of indices such as CRB index, GKX index for the agricultural. That one had like a 4 or 5% correction in the last two sessions. So since the new year has started, it gave up gains of almost 5 or 7 sessions prior to that. We're back to 455 on the GKX index. And then the GJX index, which is kind of a energy index, but slightly, it has different weightings for energy. GJX index also took a beating for the first 2 days of this year. So that's on the commodity front. Um, on the currencies front, I'm trying to figure out setting up a play as well as the timing of it for the yen's next move. So um, the yield cap expansion from 25 to 50 basis points, in my opinion, wasn't just the first move. Uh, we will most likely see a follow through for it. And what that translates into is yen appreciating. Um, this year might be the year where dollar doesn't dominate as much as it did last year. What does that translate into earnings for stocks? So if that were to happen, this is conditional probability, right? So if that were to happen, then multinationals may have slightly better than expected reports. However, their estimates are too optimistic at the moment and they need to be brought down. There's a wide range of estimates which are out there on the street. For example, the consensus is still at 218 for S&P 500. Mike Wilson is coming out down to 180. BNP Paribas is at 195. Everybody else is at 205 and above. I think we'll fall somewhere in between, so we'll probably land where close to where BNP Paribas is. But we'll see. We'll get the first sort of signal of this from the financials, which come out next week. There's also a conference called ICR conference. I'm about to tweet about it with the names of the companies that are going to be in it. There's about 75, 78 odd names. They come to this ICR conference. This year it's in Florida, I believe, on Monday and Tuesday. But just so that you know, the market caps of all of these companies are not that huge. On an average, you're talking about just consumer names, mostly consumer staples and consumer discretionary. And I was trying to just look at by gig sector, how many of them are which sector. So of the 76 names, 50 of them are consumer discretionary. That gives you a sense of what kind of uh, conference it is. It is primarily focused on the on that side, consumer discretionary side. The second part I wanted to share with you is that will start giving some sort of an idea in some of these names, such as Macy's, or Macy's is one of the biggest names. Five Below, those are some of the name. Planet Fitness, that whether or not they're facing some sort of slowdown from the consumers, and if they are, then that might end up creating some ripple through effect. But keep in mind that that conference is like relatively for smaller cap stocks, so I'm not expecting a whole lot coming out from there. I think our first signal comes from Jamie Dimon and other banks next week, and then the week after, sorry, 2 weeks after that, last week, we'd start getting all these likes of Tesla, etc. So earnings wise, I'm trying to be set up in such a way that I either capture some of the strategies for pre-earnings or post-earnings, depending upon what the play is. The last part I wanted to highlight.
Yeah, Trent, sorry, just before we move on, the ICR conference, both Penny and Belosi put on a great kind of guidebook presentation today for that, and touching base on running through kind of quickly on a number of the companies that they cover that'll have overlap. But to your point, yeah, Trent, it is sort of definitely a bit of a smaller cap to mid cap type type conference. Things like Darden, Dutch Brothers, Dave and Buster's, Krispy Kreme, Shake Shack. Those are some of those. And then from the consumer staples side, Black Rifle, Synopta, Laird, Superfoods, that kind of thing. So again, just wanted to, it's a great call out. That's happening in, I think it's in 2 weeks.
Oh, it's actually next week. So today's
Is
fourth.
it next
Yeah.
week?
So
Oh, okay.
today's fourth.
Oh,
Yeah,
sorry. I might
next.
my time's
No
all
worries, no
off.
worries. Yeah, it's
My
the
bad.
vacation.
Yeah,
It's the
you're right.
New Year, right? So the New Year fell on a
No,
Sunday.
exactly,
You
100%, man.
know,
Yeah, yeah,
it threw
yeah,
off everybody. I agree. I'm
100%.
seeing this.
It is
Yeah,
next
I'm
week.
seeing this in other walks of life too. I'm just facing like a little bit gradual takeoff in activities, so that's perfectly fine. So,
Completely. Yeah, and if anybody's listening in, if you're going to be down there, both Howard and Daniel will be in attendance. So make sure you reach out to your Hedgeye sales guy, and they'll or to Howard and Daniel directly, and they'd love to meet up in person. So I just wanted to shout
yeah,
them out
I
too.
know Jimmy's favorite Playboy is gonna be there. There's a bunch of other names too, like Napa is there, right?
Oh, nice.
And then yeah, so the average market cap on that is approximately 1.1 billion. But if you take off the big ones like Five Below, Planet Fitness, Crocs, and Macy's, then the rest of them mostly fall in the sub-billion category. So coming back, last part of the notebook, I'm seeing an underlying bullishness in European equities, and I'm trying to analyze myself that one, is this primarily because of dollar's weakness, um, or is this primarily just a short squeeze rally or relief rally for the next leg down? I have not yet come to a conclusion. Any data points on that, if somebody else has gathered, or some sort of thought process, would be appreciated. I know that last year when we had a big leg down in all of these names in Europe, that coincided with the iTrax or the CDSs in Europe going up. Everybody thought that Credit Suisse was going to go under or UBS was going to go under, whereas that wasn't the case. They were fairly well capitalized. Also, we had that fire sale because of the UK pension plan having to sell some of their assets, resulting in this sort of conundrum as well as a chaos. What's also helping them is the inflation reduction due to the energy demand being slightly less due to some kind of a apparent winter heat wave, whatever that means. So the energy demand is not as huge, so that's why we are seeing natty gas being naughty and completely crushing down below. So those are all the points that come to my mind. I haven't done a whole lot of credit assessment this week, be it in treasuries or corporate, but I'll be picking that up towards this weekend. So back to you, Rob.
Awesome, thanks. Yeah, good rundown there as usual, Trend. From Europe standpoint, yeah. Listen, I mean, if you look at the euro US dollar, the pair trade there, on the 3 month basis is basically coincides almost. The correlation is quite high in regards to what you've seen in European equities and alongside the strength in the euro. So, that to me makes a whole lot of sense. But then from a consensus standpoint, Trend, right? They're long the euro at the moment, right? So taking the other side of that is definitely, we don't always need to be contrarian in regards to our positioning, but when we've got the data that backs it up, and the data and the quad map on the horizon, it definitely allows you to sleep a lot better at night, having those two things in your back pocket, right? So I would, again, you're spot on in regards to your commentary there, but I think in regards to kind of just the European market itself, right, it definitely has regained bullishness on a trade perspective. But I think if you kind of peel down your back a little bit further and zoom out a little bit from a trend level standpoint, things remain, very, it's definitely remains, bearish trend there, right? So I think kind of
Yeah,
again
agreed.
kind of
Yeah.
depends on perspective. Yeah, just depend on perspective is that kind of thing. Going in 23, it's trend, and I don't know how you're thinking about it right now, but I'm kind of trying to assess the signals that are kind of had counter trend moves, right? And folks are not necessarily on the fence, but sort of are questioning as to like, okay, do we stick with it or do we not? Another great one would be the financial space, right? So XLF and KRE was obviously something that Coach hit the button on today. But I think analyzing that's why I kind of called out home builders, right? ITV. It's had a great on a 3 month basis. It looks quite strong, but as you kind of zoom out a little bit more, ITB again could be another great great spot here as you go into recessionary environment, and the data is supporting that. If you listen to Steiner on the call and stuff like that, you'll hear those data points, and that's backing up in regards to most recently kind of the luxury home market and the quote unquote no bid that's happening there. So that's kind of where I'm trying to pivot, but that's again what just a bit more my preference in regards to trying to capture the full cycle investing. I think right now gold and precious metals in particular, piggybacking off of Trent's commentary around the dollar, the dollar, it's possible that it's obviously that it doesn't have quite the same year or repeat year as 2022. Now, could that setup be more allocated towards precious metals? Time will tell, obviously. And right now, that signal on in precious metals, in particular gold and silver, is incredibly robust. So just kind of being aware of where those signal strengths lie, and then how can you position yourself in markets that aren't necessarily again, you don't want to kind of, you really want that signal to confirm in terms of rotating and moving over to bearish trade perspective, but doing the work ahead of time, as Trend is a master at, and certainly I do my best to mirror his energy and his due diligence, but knowing where you want to be when those signals do confirm, can prove very, very fruitful and generate a lot of alpha for you in those perspectives. So I don't know if you're thinking about it similarly, Trend, but that those to me, I think if I had a top three list, it'd probably be Europe, financials, and then probably leisure.
Yeah. Europe, financials, leisure, some discretionary as well.
Yep.
I wanted to bring to notice for everybody a few weeks ago, Elon Musk jumped on one of the spaces that I was on. So it was just coincidental, it wasn't by
Yeah.
design. And
Yeah.
he admitted, I mean, he's
He's
trying to
famous.
blame the Fed rates for all of not just his stock price fall, but I mean, he was quite candid and humble, just to give him some credit. But he quite openly admitted that one, he's going to take some sort of cuts on his profitability in order to keep the unit growth growing. Whereas the second part was more important, that wherever consumer finance is required, right? So for buying an auto or whatever, everything is taking a hit, and we don't need him to say all of that, because he was kind of interested in selling his stock. He sold 40 billion of it. As we have heard from Jay, we have heard from Josh, we have heard from everybody on the Hedgeye team, that this increasing cost of capital is just going to create some sort of savage impact on the valuation model. So definitely looking out for companies which rely on financing. If any financing is coming up, that would be important to understand. Issuances will be there because we're still having relatively easier monetary conditions as compared to 5 months ago. But I would highly encourage you to look at anything in your portfolio that needs financing, not just for the company to finance itself, but also their customers to finance their product. So, for example, in case of auto companies, the consumer needs to finance it, and they're having a hard time getting the finance on that. Then the demand for the auto company would reduce, right? So, just a clear math.
Yeah, I mean,
So,
you can say the same thing. Yeah, I mean, it can be big and small too, right,
yeah,
Trent? It can be, Caterpillar, machines for mining companies, all the way down to John Deere's for farming
yeah,
operations,
there you
right?
go.
So,
Yeah.
and everything in between, right? So it's not only the consumer balance sheet, but it's also the both private and public market capital expenditures as well.
Yeah. So the capex for both the consumer as well as small medium businesses is equally important. So I think what
Mm,
Rob was trying to emphasize was that the customer of the company in your portfolio could be a consumer if it's a B2C company, such as auto company, or it could be a B2B company where, say, Caterpillar actually deals with construction companies, be it in China or in other parts of the world, where if that activity has lower demand, then you're done, right? So looking at demand management from that standpoint, and also looking at estimates, right? If the estimates are not factoring in some of this demand destruction or demand reduction or softness, then clearly valuation is going to take a hit. So just be conscious of that.
Yeah, I mean,
Yeah.
sorry, Trent. I apologize. I think another great example, again, kind of not on exactly those same lines, but McGough, mentioned or kind of came out and put Pool on his short bench yesterday or this week, and that's another great, consumer oriented, spend, right? And just in your commentary about estimates is what maybe reminded me of that new kind of exposure, and the fact that the street has kind of flatline $18 estimates over the next couple of years, whereas they came from, I believe it was $8 or $9 previous to sort of the much easier kind of influx of stimulus money and stuff like that. So not only is that basically a double from earnings, from what the company has been able to generate and put up, but basically analysts and the street is estimating that's going to continue out in perpetuity. And again, go pay for McGough's research to get the nitty gritty on the on the actual call, but no, that's it can happen in all sorts of different exposures and different kind of industries and that kind of thing, right? So not only to the consumer, but then as I was alluding to, kind of the businesses themselves. So
Yeah, and just to
are you
add
paying
to it
attention?
and build on that, two aspects I wanted to highlight was today's 11 a.m. Eastern call with Mike T, right? You may have seen on his board at the back, he had like a few things he had listed. One of them was called Management Delta. So, Management Delta is the guide, the guide that the companies give for future. And then that actually translates into the consensus estimates because the analysts on the sell side tend to just mirror what the management is saying with little or no objectivity with respect to what alternate data might be suggesting them. And that's where your alpha lies, right? So, for example, if you feel that the management has not given adequate guidance and they're going to come up with a guidance which is going to be lower. So, for example, when dollar started becoming stronger, Microsoft and a couple of other global companies started saying, oh, dollar is going to kill us, so we're going to reduce our guidance by so much. And that kind of started crushing the stock. So similarly, if you find that there's a management delta, then go for it. Taking the right stance or positioning yourself correctly. The second aspect is also consensus estimates delta.
And and it can go both ways, right? Management delta. So
Yep.
if you're looking at some of the healthcare stocks right now, and Tom Tobin's been been all over this, but he's been really kind of highlighting the services space, and the management delta is there too. Trent, great call out, and really good to highlight exactly what's how Mike Taylor kind of makes a lot of his some of his decisions or some of the influences to his decision making, I should say. But the management delta, 100%, as well as consensus estimate delta, they can go in both directions, both in a positive and a negative light. And I think that's really, again, like, we're obviously, quad fours are on the horizon, but you really got to try to make money, both on green days and red days, inside of the portfolio. So being nimble and understanding and thinking with both sides, I guess both sides of your brain or both sides of the portfolio really is quite crucial. So looking at those management deltas from both perspectives, right? So whether it be piggybacking off of Trent's commentary there, whether it be FX exposure, right, that could be negatively impacting companies. Again, I'm no position in Caterpillar or Deere, just FYI, but the Caterpillar in particular is a global player, global giant, and primarily transacts in U.S. dollars. So that could have a positive impact to Q4. But given our outlook on the dollar and where we see it going from here, that could have a negative impact moving forward throughout 2023. So just being conscientious and understanding sort of some of the levers within the balance sheet, within the financial statements in particular, and how that could impact certainly near term or companies on an intermediate term basis, as well as what that setup could look like on a trending basis. Again, just to the whole point of everybody joining this call is to generate alpha, And that's what we're here to do in 2023, just like we did in 2022. So let's fucking go, boys and girls. All right, we got my man, Big Brian. I wonder if he's at Disney. Are you at Disney again?
I just got back.
Just got back.
I did. I got back on Sunday. I did.
I hope you had a great time.
We did. We love New Year's week, and had a great time. Great fireworks show, and ready to get after it. Just got
awesome.
I had to laugh. I just got this email from Fidelity, and it says here at the bottom, why now might be the time to diversify. The 60-40 portfolio can still help you meet your financial goals. And I hit trash and put it in the trash can, but I thought I'd pull it up real quick and read it because it's still there. They still haven't learned, right?
No.
Oh my God, it's just like painful. But just wanted
to tell your friends, right, Brian? Tell your friends there's a free spaces every Wednesday. You know, if they don't want to commit to the Hedgeye subscription, you know, there's lots of ways to learn, right? Lots of ways to learn.
No, it's
so you know, there's a better way to do it than that 60-40 portfolio. That's for sure.
Yeah, and I'm taking the lessons that I learned in my first year with the Hedgeye process. And I'll get into that. Let me just hit on munis real quick. We had a pretty big day.
Yeah.
So the 1 year muni rallied 8 basis points and the 20-year rallied 7. So just think about that. I mean, that's a pretty opposite move of what you would think, right? The 1 year moving more than the 20-year. So it gives you a little feel of what's going on in the muni market. The other side of the coin is muni market prices off of a sheet that comes out every day, and it's got year 1 through 30. So all of last year, the year 1 year was 2023, right? Because you're in year 2022. And so when you get to the next year, 2023, the first year that they print it, first day of the year that they print it, they drop 23 off, and 24 becomes a new 1 year. And everyone says that does not mean anything, that rates adjust in what we call the interpolated scales, but I just have never subscribed to that theory. So we got the first year yesterday, they did what they called a roll, and they rolled around 5 to 10 basis points. And then here today, we get another 8 to 7, depending on where you are in the yield curve, which is really, really big moves in the muni market. So the fund that I like to kind of watch is a proxy's rallied 1%, a little bit more than 1%, I think, over the last 2 days, which is a pretty big rally for a municipal bond fund. So there seems to be some support right here at these levels. And then just looking back, I bought, I pretty much, maxed out my municipal bond portfolio last year. And looking at the high end of the year in the yield in the 20-year space on AAA was a 393. Today, it's a 331. So that's a difference of 62 basis points. That's a really big move in municipal bond yields. So, we've had a pretty good rally here. Does it continue? I don't have a crystal ball for that. But certainly, Q3, Q4 of last year, we had some highs. And for those that locked in, good for you. Hopefully, it'll continue to work. Trend had sent me an article, and I had a couple other people ask me about closed-end funds and, whether I was investing in them as from a trade perspective or from a long duration perspective. And I've started some research on it. I'm still not there, and I'm still not there because of the leverage piece. I would hate for somebody to get invested heavy into a product that, number one, they really don't understand too much about. But number two, that's 30 to 40% levered, and then to have the Fed just ruin your whole month to maybe your year. So I'm not there on closed-end funds because of the leverage piece. The one I tracked the most on the leverage front is BTT, and I noticed it barely squeaked out a gain today when my generic, insured municipal bond fund MMIN was up 59 basis points. So I'm just not there. I don't think taking the leverage risk is something that I would do right now. So that's kind of my position on closed-end funds. And then in terms of the Hedgeye process for me, and I've had some immediate success with, is I'm trying to be much more disciplined on the risk ranges, and I'm trying to build my short book. So yesterday, we started the day off where the Russell was right at the top end of the risk range. And right at the open, it went just right at it, maybe a couple ticks above it, and I shorted IWM, and by the end of the day, I was up 3%, and I took some profits, and then I rolled into the 3 times bullish short, so I would get the theta burn like Mike Taylor likes to talk about going forward. So I've shorted BitO, I've shorted CCL, Carnival, Meta, and IWM so far. And I'm only going 25 basis points at a time, so I'm gradually kind of entering into these positions. But I really want to get better at running and understanding kind of the equity side of my book, where I know what my longs are versus what my shorts are, and can appreciate the balance of the two. And so that's something I've been working on, and been sharing in some spaces, and appreciate everybody's help. And then lastly, and I'll wrap up here, I've had a few people reach out to me on fixed income outside of munis, more like taxables, and it's really for more like retirees and things. And CDs are something that I track too. I don't own any CDs, but I like to track them. And I like to track and look for monthly pays with call protection. And last year, I think I tweeted out there was one at a 475 for 18 months. And right now, their Fidelity went from 90 positions to 156 available. But the best one that meets that criteria is a 460. So we've seen a little bit of lowering in the CD space. But I noticed the number of CDs that they offered has grown quite substantially over the last couple of days. So those that are in that more fixed income space looking for CD income, just note last year the best one I saw was 475, and maybe there'll be some here again. Maybe they won't. Don't know, but that was the best that I saw. Other than that, Robert, I'm looking for some help on how to play Mike Taylor's two-year U.S. Treasury play.
One quick thing. So the article that Brian mentioned is up in the tweet nest. Take a look. I've also added the ICR conference related tweets and also the Mike Taylor tweet where we noted down his stickers. So the article that Brian mentioned is up in the tweet nest called End of Year Tax Law Selling Widens Discounts from NAVs for close-ended munis. So take a look at that. Definitely, as Brian has suggested, the leverage ones are not good ones to play with in this arena. And also, we are not seeing times of distress. I think distress would be the time when it would be the most lucrative for somebody to just add these to your portfolio for holding them to maturity. Back to you, Rob.
Yeah,
and Trend, just make comment. The holding to maturity trend. So most of the closed-end funds, pretty much all of them, don't have a maturity. They just are continuous. The BTT that I mentioned, that is a trust that does have a 2030 target term where it actually ends. So just know that most of those funds, they do not actually end. They go on forever.
Right, very important aspect, because then the idea is that you may not get the convergence that one usually tends to get when the prices deviate from the NAVs, especially with some of these funds having pretty expensive fee structure. Definitely follow what Brian is saying.
And I think I also wrote you back, Trent, that most of these things own what I call shit. I mean, there's bonds that I would not want to own. I think the one they mentioned in the article, it's high quality. It's fairly decent credits, but if you wanted to get really deep, go to MMIN Fund and read what they own, and you're starting to read normal flyover state utilities that have been in business for 100 years, and it's not some toe rolled in some metropolitan area where they have a population leaving. It's a totally different credit structure. So, be mindful of what you're buying if you're playing in those fund spaces.
Yeah, so it's a little less San Francisco, a little more Topeka.
Absolutely, that is Brian's. That's the way I like to do it. But
if I could, yeah, exactly.
So,
Brian.
But Robert, let me ask you a question. Tell me about Meta here. So I shorted Meta today. I saw the risk range 120. I watched the macro show. I heard what Keith's comments were.
Yeah.
I only did 25 bips, and I saw it go to. I did it right at 127. I saw it go up to just over 128. It settled out at 127.37. Yep. What are your thoughts on Meta?
That signal is getting stronger.
Like bullish or?
I mean, it's not bullish because it's got so far to go from from the trend standpoint, right? I mean, the thing's down. I mean, just it's been cut in half, over a half in the last year, right? So, but it's putting in the higher low and a higher high, and that where it closed today is a new 1 month closing high. So, I'm paying attention. Meta, I can't short Meta, but so I'll do that via XLC, right? So XLC would be my way of expressing that exposure. But in Meta in particular, keep an eye on where that risk range, where the top end of the risk range is, and where that lower end. So the lower end of the risk range as of today would be putting in kind of a 1 month low, right? So again, these are kind of it's traded sideways, kind of. Again, I'm rounding it off, but kind of at the last month of the year. So kind of in December here, it's basically traded relatively sideways between kind of like 113 ish and 130, right? Or up until today, kind of 125 really. But so that was one I definitely had my attention, Brian, today. Did not execute there on XLC. I wanted to kind of see how things played out a little bit more, but yeah, I mean, it's definitely, it's a perfect example of like a counter trend like trade, right? Or potential counter trend trade move here. And really it's somewhat has happened over the last, within the last 3 months. So kind of since what was it, kind of post earnings there in late October, kind of going into early November. Right, it got all the way down to like $90 and kind of has quote unquote rebounded to 130 here today. But so that is that's a counter trend kind of bounce. But listen, you're definitely hunting in the right ballpark. But if I had to, if in terms of the risk range that we get to every day, hold on, nope. I mean, Microsoft is an absolute dog. I mean, tech continues to look like dog shit. So if you were quick on the draw this morning, Amazon was right there for you. In terms of where it was on the top of the end of the range, that would have gotten you paid. Not Tesla, Google, Meta.
What about the Russell? Because the Russell's been much more towards top end of the risk range than the Nasdaq.
Netflix is picking up. And Netflix is higher lows, higher highs too. So that's actually a bullish trend.
Yeah, it's bullish.
So again, if I know I don't want to like overcomplicate things as you're kind of getting to as you're sort of dipping your toe into the short side of things, but this is like Meta and Netflix. If you're short Meta, getting long Netflix, which is actually in a bullish trend. All right. And Meta is in a bearish trend, right? So you're definitely like executing and thinking about things in the right way, but having it again, maybe it's 1-to-1 or however you wish to do it. But, if you, on red on Netflix, right, getting a little bit of exposure there, will help offset. So it's kind of what would be called more of like a pair trade, right? So you'd be kind of, again, they're both in the communications, arena. So you could be kind of like long Netflix, short Meta. And again, depending on your ratios, typically you go kind of like 2-to-1. But so I think you said 25 basis points in Meta. So if you did put on like 50 bips at Netflix, again, closer near the low end of the range or sort of like below the midpoint of the range, that would be could be a nice way to kind of offset any sort of near term strength in Meta. What did you say in terms of the Russell? Is that what,
Yeah.
was that
So
a
the other
question?
thing I was seeing, so at the close, looking at this morning's risk range, I see that the Russell, it was down, and it's back up, close to the top end of the risk range.
Yeah.
While the Nasdaq is sort of like right in the dead middle, and SPY is kind of like 75% north of the risk range from the low. So it just seems to me like the Russell is the one that is the short right now, just in terms of where it is on the risk range. And then I guess the other way I was looking at it, and maybe this is wrong, but the Nasdaq's down over 30%, while the Russell is really more in the 20% bucket. So, does that mean that there's a lot more selling that could occur on the Russell than the Nasdaq? How should I think about that?
Yes, Trent, jump in whenever you wish, but I would say absolutely do not think about it in comparisons from a Nasdaq and Russell in terms of what they are down on an absolute basis. That is in my humble opinion, that is not why you should want to be short Russell versus the
And
Nasdaq.
there are
So
reasons for that. So, about 3 years ago, I'd done a very detailed constituent analysis of Russell. If you look at the way Russell 2000 is filled with, it is filled with a bunch of banks, okay? It is filled with a bunch of biotechs, and it has a very heavy duty domestic exposure. Whereas if you look at NASDAQ 100, they have zero financials, because they don't want to have financials for whatever reason. And they have a ton of long duration assets. So, uh, banks inherently tend to be shorter duration assets, and I am not referring to like the SoFis of the world, but I'm talking about the banks which are there in the IWM constituency. So that's why, from a pair trade perspective, Nasdaq and IWM um, have very less number of factors that are in common. Also, market cap size wise, uh, IWM tends to have a slightly different set of uh, market caps as compared to Nasdaq. So that's my assessment of where they both tend to be together or differ. IWM is a good hunting ground. Constituents of IWM are a good hunting ground to find um, stocks which have any credit crisis or whatever. The easiest way to do that is just search for IWM holdings, and you'll directly get the holding spreadsheet from the issuer's website, and it tends to have one column called sector. I use the GIX model by using an API I have for Sentio, but you can definitely just use that sector bit and see that if you do a quick pivot on that holdings file that you'll get from the IWM's issuer. IWM's issuer is iShares, so on the iShares website you'll find the file. If you quickly pivot by sector, you'll find the weightages by sector, and that's where I would say that I never try to pair Nasdaq with the Russell in general. But if you're trying to construct a portfolio, that's a different activity altogether. The other aspect I want to highlight is that small cap value is picking up some sort of steam on a relative basis when it comes to overall rotation that has been in play. And when I say small cap value, I'm talking about in the traditional sense value. So if you track this index called as uh, DJUSVS, which is Dow Jones US Small Cap Value Index, it is relatively speaking, it is outperforming the large cap value index as well as the small cap growth index. So I just want to throw that out there also, that there's a little bit of a small cap value factor, which is most likely some sort of a pre-earnings rally phenomenon that happens, and then as the results come out, earnings come out, and the guidance comes out, they tend to moderate. So those are a couple of aspects I wanted to provide as an input. I hope that helps and doesn't complicate things further.
No, I appreciate it. I think what I would compare it to is where Keith talks about why he doesn't usually short SPY. That's because contains, things that do work well in quad forward. I think what you're saying is the Russell has some components to it that do well potentially in quad four, as opposed to the NASDAQ that does not really have
Yeah,
that. Is that
that's
a
right.
kind of simplified
Yeah,
way?
that's right.
Okay. Okay.
Yeah,
Thanks,
and you
Trent.
can also and you can again there's like IWO, which is growth, and IWN, which is value, right? So you can kind of narrow it down. This is where I think diving under the hood a little bit and spending some time on the holdings, Brian, and the sector exposure can be valuable, right? Can be a valuable worth or a valuable time spent, right? So that you kind of really do understand. And then the other thing too, in terms of a lot of the underlying U.S. industry like ETFs, right? So I'll use retail like XRT as an example. If memory serves, there's a decent amount of, again, there's obviously their core holdings or some of the larger caps, but then as you kind of dive under the hood more, there's a lot of kind of smaller cap names there. So kind of understanding again, if you can do some form of kind of analysis, right? Or use, there's many kind of tools out there that where you can kind of further dissect sort of the ETFs and pull up ones with small cap exposure in sectors that we certainly don't from a Hedgeye standpoint. I think are worthwhile to have, or sorry, are more worthwhile on the short side than they are on the long side, right? You can kind of narrow it down, but at the same time, IWM has been on ETF Pro for quite some time, and I want to say probably going all the way back, I'm not going to misquote myself, but it's been on there for quite a while. So, so again, we are definitely absolutely short the Russell. It is bearish trend. It remains that way. In terms of the risk range, going back to your question there, that's what you did yesterday. Kind of how you were quick on the draw yesterday. I think that makes a lot of sense. Today, wasn't quite there, but you had some underlying components within small cap that was right. And so if you kind of go back, again, I'm not going to give away all the RTAs and what have you, but if you go back and look at some of the RTAs and where Coach was hunting, that a number of them had some, call it some small cap and as well as definitely high beta type exposure and high short interest exposure. That again, I think is a great way of thinking about it as you're kind of getting your feet wet from excuse me from adding shorts to your portfolio. So you're definitely thinking about it correctly.
Thanks, guys.
Yep. But everything is dynamic, right? So like those risk ranges, again, I know you use those as goalposts and we all do, but those are dynamic and I don't want that as like a cop out. So I think just understanding kind of, how it's price, volume, and volatility, right? So making sure that you've got those on your screens, right? So like the RVX was down a little over 2.5%, down just under 26 today. So kind of understanding, listen, RVX is down. I don't know what volume was like on IWM today. IWM volume was up today, right, in terms of on versus average, so up slightly. I mean, nothing to really write home about, to be perfectly frank with you, but it was up on a green day with volatility down. So again, those are kind of constructs there that I'm not saying don't short it, right, but it's all about kind of like understanding the existing setup, right, and sort of maybe being a little bit more patient for the top end of that range, closer like you had yesterday on the IWM, where it was on the really close to the top end of the range on the trending basis, right, Brian? And I think that's perhaps where you so again, that's a longer duration. So that's really, in terms of getting sized up, that's a spot where that's a fat pitch, right? So having that in your sights and being nimble enough and able, aka don't think, just execute, to push the button there when you get that set up. That's awesome and great on you for being there in the morning and covering some later in the day. So good job.
Yeah, and I got to give a shout out to I think it's Todd Enders, who is his portfolio in the Hedgeye process community.
Mm-hmm.
And he one of his takeaways from year end was to be a little smaller going into the shorts and building them gradually. So I kind of took that in his lesson from 2022, and that's why I'm only doing 25 bips at a time. Going a little short, you're just going smaller.
Yeah, I mean, listen, if you really, again, it's all about your process, but you if you think about it as, typically shorts are half the size of your long. So, that means you got, less bullets. So those bullets need to be, in order to kind of have equivalent number of bullets, let's just say, 4 to 8, you got to be smaller in terms of your entry sizes, right? So it makes perfect sense. And short selling is really, really, really fucking hard.
I just do what Keith does. It's kind of easy when you just follow him.
Yeah, exactly. Keith, listen, we've got great tools for it here at Hedgeye, but it is really fucking hard. And you definitely don't want to fall in love with your shorts. Shorts are inventory, so make sure you're rotating it around and that kind of thing. Jimmy, you've had your hand up for quite a while, so I'm sorry for making you wait, my man. But welcome. Hopefully, the West Coast is beautiful as ever. You certainly look like you had a great holiday, great Christmas with your family. So hopefully the New Year's off to a rocking start for you.
For sure, man. 2 green days to start the year. Feeling good. Happy New Year, Rob, and to the rest of Hedgeye Nation. I missed some of the beginning, but always a fun conversation. I think just a couple things that I would add is when was the last time that Russell vol was lower than NASDAQ vol? Brief little inversion here, right? It's getting kind of fun.
No, it's true. It's true. Where did hold on. Vixen ended, I think it was around 28. Right? Yeah, 28.36, 28.36. Yeah, and RVX is 25.89. It's a great call.
And that's what I was pointing out earlier about the small cap value as well. It was related to that. But good call out, Jimmy.
Yeah, and Trent did a great breakdown of some of the different components and what was running and what was not. And even if you think about the end of last year when you had some of the energy components and some of the industrials that were in the small cap indices that did better on a relative basis. But I'm taking it a day at a time. I think Brian did a great job hitting the short button on Russell yesterday when it was above the range. And, one of the things that kind of got me spooked during these bear market rallies was that if something was moving way above the top end, I would take a little time to see how the day played out before because I knew implicitly the top end was going higher. But obviously the first day, the rally faded really quickly. We did get a chance this morning. The refreshed risk range to start the day was 1779 at the top end. I think we hit 1790-ish on the small caps. So I shorted some there. But it's going to be quite interesting to see how the year unfolds. My only take on Netflix and Meta, and this is just pointing out some numbers, is I still remember when Coach was saying how when Netflix went bullish, it wants to get to that max pain point, that shark line, which was north of 300. And if you look at Netflix, it's been 9 months now since they cratered. They dropped in April of last year. And, if by comparison, they're kind of back to their COVID low, whereas for Meta, the COVID low is still maybe about 10% higher. And it's also that same level where they fell off just 3 months ago. So certainly there's a passage of time that's required. But, I did short some Meta today too. It definitely looks kind of interesting. If you zoom out far enough, it almost feels like the October period was a capitulation point, but the game gets more interesting over the next 5-10%. So save some ammo, but just the broader market setup, it just looks awful. Tesla going bidless when Microsoft is down 5% on a downgrade, retesting 52-week lows. The dichotomy of the short game is interesting because short and hold is not a strategy, but at the same time, when VIX has been low, there have been times where I feel like I've had great entries into the shorts only to close out so early, right? You get a couple percent, whether it's an RTA or something, it's these are core shorts. And when I think about how the year will play out, I'm still trying to get more patient. But if I can short plug at about $13, that's $7.5 billion of market cap. I think they have maybe $2 billion in cash. So some of these I'm going to be patient and take notes on why I'm shorting it and over what duration I'm going to measure my shorts because I have so many small caps to offset it. So just going to try to be better with the notebook, get back to the notebook. And it is cool to have a clean slate. It's not, in some ways nothing changes. but in other ways, a lot of things can change psychologically. For all the value I thought I was getting going into 2022, I realized there's just so much ego because like my small caps were underperforming already and the market was up 20 something percent. I felt like I wasn't catching up, and then how 2022 went for some of those names. So but good to hear from you guys. I'm going to stay tuned, and we'll let you know how the year unfolds.
Absolutely. Yeah, absolutely. I'm looking forward to it. And just to clarify, that was I was not saying Meta was a buy. I was just saying that it is absolutely still a bearish trend. It's just that it's been putting in higher lows and
100%.
higher highs, certainly day over day and kind of week over week. If you go back to like the 23rd, that low end of the risk range was 111 to 123, and you guys all can go to your risk range product and see where it was today. But so again, just things to be cognizant about. Because going back to the wood in terms of like what has happened, does it just in terms of the quote unquote sexy seven that we get daily, to in my humble opinion, there are slightly better areas to go hunt right now, and tech in particular, just absolutely. It looks terrible, to be perfectly honest. So
I'll just interject with one
great.
comment and one question before I hop off. I
Yeah,
love
by
that.
all means.
Yeah,
Just
yeah,
wanted
no,
to
you're
clarify.
right.
I didn't want anybody to think that I was like saying like buy
No,
fucking Meta, right? Like,
yeah,
excuse me, I dropped 3 F-bombs tonight. That's unlike me. So sorry
no.
about that,
I love that
guys.
Keith pointed out ESPO on the macro show this morning. I love esports. Don't get me wrong. I think that's a mistake. I love the e-gaming sector, but I'm gonna respect the machine. So that was a cool little call out that he did, for sure. And I got a question for the rest of you guys. Like when you think about just the way that 2023 will play out, there's so many different setups, and I guess we're at a point of quite a bit of uncertainty. Is there anything different that any kind of New Year resolutions for you guys in terms of the process, or if you kind of reflect on what you did well last year and where you messed up or where you could have done better? And try to learn from you guys, and especially for those of you who had a great year.
Yeah, great question, Jimmy. So thank you for that. Before we get into that, I do just want to try and mention the tweet nest. I got a couple tweets last week or 2 weeks ago, excuse me, around like what does that mean. So if you just kind of pull like kind of where we're talking, or sort of where you see our avatars or what have you, just pull that down. You'll see some dots up there on the top of the Twitter space. You just pull that down. You can kind of scroll over to the right or left, and you'll find some tweets. It's called the tweet nest. It's a lot of them are from Trend, and he's posting. I'm kind of highlighting this because he's posting some really great kind of commentary here, and most recently the breakdown in terms of IWM from a sector standpoint. So about a little over 17% is financials, a little over 16.5% is healthcare, 15.5% is industrials, 12 and 3/4 is information technology. So again, that's the kind of top 4 sectors there. But just wanted to highlight that for everybody who wasn't familiar with what a tweet nest means. Looks like Mitchell's got his hand up, and so I'll go to you, Mitchell. But the short answer, Jimmy, for me is options. So I got to get better at my options game.
So I'm not in a great spot to chat, but I did want to mention something regarding small caps and market structure. For those of you who were around in 2008 and 2009, and this goes back to something that Keith talked about, or he's talked about a couple times in the last handful of days, people are selling what they can sell. Eventually, they will sell small caps. And just as small caps in a reflationary quad 2 go vertical, they will go down whether or not they are a good company or not. And they will go down hard. You will have small cap financials, mid cap financials go bidless. And I've seen it. I've watched it. I've lived it, and I've been on the institutional desk while it's happened. So while the Russell is what I think in the tweet nest, as Trend said, as it says with Trend's tweet, 17 and change percent financials, those financials, again, whether it's a small cap bank, small cap thrift conversion, they will go bidless, and those companies that traffic in financials, They will need to seek liquidity, and they will sell anything they can at any price they can at any bid they can, and in cases still won't sell. So
That is
the
true. Yeah, in fact, it's
IWM is showing what it's showing. I get it. I'm not questioning that. I'm not saying don't follow the signal. Follow the signal. But there are stages. Keith keeps labeling them phase 1, 2, 3. I don't care what you call it. There comes a point in time where after the liquidity, after the really liquid stuff is sold, they have to go in and they have to get rid of their small caps. And when it happens, it's violent and it happens fast. So I'm just throwing out that warning.
yeah, and
Play
actually, that's a
with your
great
eyes open.
point that
That's all. And
Mitchell.
I apologize. It's too loud around me, but thank you guys for the weekly notebook session. I'm glad to be back on and hopefully get back on in a more regular fashion. So you guys are killing it. Thanks.
Yeah, that's a great point that Mitchell brought up. I wanted to definitely uh, put a caveat around that part. So the constituents that I had labeled were only for the comparison between Nasdaq versus IWM. What are the underlying components? Definitely, if one wants to go short with the end game being ETF selling, causing some sort of overall uh, overall bidless sort of selling, then IWM is your best hunting ground, right? IWM is there. There's components of IWC which are also less liquid, but they end up going bidless too. They're also great source when the Fed would pivot. They're also a great source of screening for stocks, where sometimes you'll find stocks where the net cash of the stock is higher than the market cap. I found one, three or four such stocks during the March 2020 sell-off, where there's a company called Channel Advisor or ECOM. They're based out of North Carolina. They're basically a company which provides services to e-commerce sellers, and they provide a platform. So they're essentially a software company, but they're selling at like $4 or $5, close to like $300-400 million, and they had more cash than that. Eventually, just recently, last year, they got bought out for $23 a share. So um, the IWM constituents act both ways. So if you have a scenario in mind where we are going to see the bidless sort of selling in ETFs, um, those are your best places to stand on shorts when the market is liquid. And when the market is illiquid, you can literally place any bid and it would get hit and you would cover for a huge gain. And on the other side, when we transition from quad 4 to quad 1, quad 2, at that point of time, those stocks end up being multi-baggers as well. So have your screeners on, keep them on the standby. Once we go through that phase of huge sell-off, you'd also be able to screen those as well. And thrift banks, as Mitchell pointed out, they have some uh, underlying credit related issues sometimes, which are not as transparent in their filings. I used to be an examiner for the SNL banks during the 2008 crisis for FDIC. And I had seen banks which seemingly on paper wouldn't feel like they would go under. There are a bunch of banks in Sunbelt. They started popping out of nowhere, and whenever we used to analyze them, we used to find loans that were given out to friends of the banks for 50-year duration or 100-year duration, as well as on terms which were unbelievable. So these kind of things do happen in the smaller banks, and some of these banks, they trade at like really wide bid-ask spreads, be it in IWM or be it in some of the IWC stocks as well. So yes, those are fraught with risk. If you want to stand on them with an intent that you see this kind of bidless sell-off, that's a good hunting ground, definitely.
Yeah, and Trent, sorry. I mean, I think you shared that mainly because you wanted to show the diversification within the IWM in terms of
Right.
sector exposure versus something like a Nasdaq. But when you go look at it, I mean, we're short financials, we're short tech, we're short discretionary, we're short energy, we're short real estate, and we're short communications. So healthcare is up there. where we belong it. And so again, it's like to your point, it's one of these things where you have to understand what you're what you're shorting, right? So 16% of the portfolio is exposure to healthcare. I'd say we're also probably, we're leaning more short industrials, even though that's not like official on the page. But out of the top sort of 1, 2, 3, 4, 5, 6, 7, or 6 out of the top 7, excuse me, from a weight of the Russell or IWM, we're short those sectors, actually more than that, 7 out of the top 8. So, it's again, it's just, but also understanding that you got exposure to utilities and staples and that kind of thing as well. But yeah, no, good call out across the board. Thank you, Mitchell, for stepping in. We definitely missed your commentary and comments, or sorry, commentary and comments is actually the same thing. Your commentary and your viewpoint. So really appreciate you stepping up there. Hopefully, it sounded like you were at gymnastics, so hopefully your daughter's crushing it. All right, so we're moving up on almost an hour and 20 minutes. Time flies. Trend when you're having fun, you're having a great convo. Best spaces out there. Let's just say that.
I actually wanted
so
to call out for David Salem. He's in the listeners. So if he can and if
I
he
know
could join, that'd be great.
I invited him to speak, but I don't know if he's able to do
Okay,
so.
no problem. I just wanted to give a shout out to him
so
that his
so
event with
if anybody's
Keith
not,
was awesome. So, for those who haven't been able to check that out, definitely check out that interview with David Salem and Keith McCullough on the Hedgeye portal. It was a great discussion. Definitely, I took a lot of notes to find in the process. So maybe at a later time, Rob,
yeah, that's awesome.
We could plan out something with David.
Yeah, no, I think you'd definitely be into that. So I'd love to do that. And for anybody looking for that one-on-one, that real conversation with Keith, it was on December 13th. So it's on the Hedgeye. It's likely under Hedgeye TV. I can try to find it and kind of retweet where it is out there. But it was a phenomenal conversation, all about building blocks and foundations and getting the foundations right. He used a great example, which, to steal his words, is also the example was Eiffel Tower, and it's just great on so many levels. But I won't steal his thunder, and you guys should go watch that interview if you haven't already. David's an absolute, he's a true gem, and a wonderful person, and I'm very grateful to be able to have met him, got to know him a lot better over the last couple months. But yeah, so David, this is me telling you that you, Trent, and I are certainly going to have a one-on-one convo here soon. So we'll do our own real conversation, but it will be with the people, the Hedgeye Nation. All right. So as we kind of move on to the hour and a half mark, why don't we open it up? Anybody out there who, either wants some further clarification on things that we've talked about so far this evening, or just has some other additional questions as we kind of go into 2023. Jimmy did kind of have that question about kind of what you're wanting to improve in 2023. Mine was options trading. Trent, I don't know if you had one yourself.
Yeah, I actually, with the
you're
new
kind of a rock star. So.
no, with the new event in my life with my newborn, I want to figure out where is it that I am doing more activity for low returns, and I want to trim that out.
Yeah.
So I would be willing to forego some returns in order to get some more free time. So that's my resolve for 2023, that if I was doing, 40 hours of investment related work, can I bring it down to 30 or 30? Because I have a separate 40-hour day job. So, can I bring that from 40 down to 30, 32 and still maintain that, because I definitely want to give more time to my baby.
Yeah, no, it's critical. Great job. All right, so I'll anybody out there, you got any questions, commentary?
One last thing I wanted to touch upon, Rob, was regarding the ETF cows. This is for the cash cow companies. Just take a look for everybody. Just take a look at the holdings of cows, and it has, on a relative basis compared to S&P 500, it has outperformed S&P by almost 900 or 1,000 basis points. So take a look. You'll understand where the machine is leaning on in terms of shorter duration assets, higher cash flow kind of companies. So you'll understand really well what kind of factors are in play. and most likely until Fed pivot happens, that trend shall continue. So that itself provides you a good long short, right? Like if somebody was long
You talking about? Are you talking about bull or cow
cows, so
with an
COWZ
S?
or something.
Oh, cows. Got it.
Yeah.
Okay. U.S. Cash
Yep.
100. All right. Cows with the
Yeah,
Z.
yeah. It's a
Yep. Or
Pacer
Z.
US
Pacer.
Pacer US cash cows 100 ETF.
Yep.
Yeah.
Got it. Got it.
That just take a look at its
Um,
holdings. And when I was assessing my core on 31st December, I realized that this one ETF did very well. Some of the top holdings include McKesson, CVS, Nucor, Occidental, Gilead. So
yep.
definitely take a look at the entire holding set. You'll get a sense of um, what kind of factors have prevailed.
Yep. And Moo, on the other hand, to lean into this the cow situation, continues to break down. So that is making new 1 month lows. Well, not as of today, but as of I was close yesterday. Was it yesterday? Yeah, pretty much spot on yesterday. So put that one back on your horizon on the short side. We had been long it for a while at the beginning of the year because of the agricultural exposure, that kind of thing. But it has broken down and continues to break down. So put that bad boy back on your horizon. So that's Moo, MOO, and then cows, COWZ, Moo short, cows with a Z, long, or at least some of its components, right, Trent? Hard to be outright
Yep,
long
yep.
anything, So do your own due diligence, not investment advice. I like that. That's a good a good heifer pair trade. Cows and moo. All right. Well, you guys. I guess nobody in the crowd. You're either busy, you're traveling, or you're going home, what have you. But that was I think pretty heck of a good hour and a half there, Trent. So no one's stepping up. So you know what? That's I think we'll just end it with the heifer joke. That was not very funny. More of a dad joke there. But next week we'll be back 4:30. So again, if you missed it at the beginning, 4:30 is our new time slot. Moving away from the mid-afternoon market hours and back to kind of original kind of one of the original slots, 4:30. So 4:30, kind of between 23 on Wednesdays for the weekly notebook review. We've got a beginner's guide this Friday. That is for Hedgeye paying subscribers only inside of the arena. So that'll be at 11:30 this Friday. So we're back at it with that one. And then we got a lot of other kind of new content within Hedgeye as well, kind of coming in 2023. Miami regional, is also happening on later this month in January. It's on the 24th. So if you're interested in flying down to that for our 1 day conference down in Miami, I believe there's 8 analysts speaking at the conference, along with a attendees only macro show hosted by Keith and Jonesy Buds. And then there's dinners as well that evening with a number of the analysts together. And yours truly is also hosting a dinner. So if you if you wish to participate in any of those, attend the conference and what have you, definitely would encourage you to do that. It's a great way. I think one of the besides all of the wonderful content and knowledge that you gain, I think one of the other massive components there is just getting to meet other people that are like-minded investors. They approach the game with the same joie de vivre as we do here on the weekly notebook review, and with the same type of mentality, energy, and really kind of passion to generate alpha. So that's one of the definitely the massive side benefits beyond just the fact that we you also get to learn a lot of great content and that kind of thing. But anyway, with that, we'll wrap up, and I will see you guys next week. So thanks, Trent, for all your commentary. Super helpful, is awesome. Brian, other side, appreciate it, boys, and good luck out there.